The craziest week in crypto. Are you ready for it? Bitcoin just blasted past a new all-time high, and that was only the beginning. In a single week, we saw price explosions. We saw massive hacks. We also saw political chaos and moves from Wall Street that could reshape everything as we know it. If you missed even a day, you missed quite a lot. Welcome to JRNY TV, where we break down the biggest stories in crypto so you can always stay early, stay sharp, and capitalize on what is coming up next. This is your weekly roundup on the wildest headlines in crypto, and this week, it was absolutely insane. From Bitcoin's record-setting rally to a $200 million hack and US states planning a Bitcoin reserve, there's a lot to unpack. So let's get into it. We start with the big one. Bitcoin officially broke through its previous all-time high, soaring past that $111,000 mark, according to multiple exchanges. That particular milestone came on Bitcoin Pizza Day, adding a layer of narrative fuel to an already explosive chart. It wasn't just retail-driven pump, it was institutions that are backing it, with JP Morgan opening access for clients and ETF inflows continuing to stack up. It is clear the bulls are back and the market isn't waiting for anyone. But while Bitcoin soared, chaos was unfolding elsewhere. Let's dive into that story. The geopolitical shockwave that pulled the entire market down just 48 hours later. Trump's tariff bombshell sends shockwaves through crypto markets everywhere. Just days after Bitcoin had reached a new all-time high, the markets were rattled by Donald Trump and his steep tariffs. On May 23rd, Trump declared a 50% tariff on European Union imports and a 25% tariff on smartphones manufactured outside the US, targeting companies like Apple and Samsung. The immediate market reaction was significant. Bitcoin's price dropped to around $108,500, marking a 2.7% decline within 24 hours of that announcement. The broader cryptocurrency market also experienced a downturn, with over $130 billion in market capitalization wiped out in a matter of hours. Equity markets, they mirrored this volatility. Apple stock fell by 3% following the tariff threats, reflecting investor concerns over potential supply chain disruptions as well as increased production costs. Those analysts are suggesting that these tariff announcements, they could have far-reaching implications, potentially even leading to increased inflation and a slowdown in economic growth. This uncertainty has prompted investors to reassess the risk, leading to heightened volatility across financial markets everywhere, including, but certainly not limited to, cryptocurrencies. The Cetus DEX and the exploit that drains over $220 million from Sui's ecosystem. On May 22nd, Cetus Protocol, the largest DEX on the Sui blockchain, suffered a significant security breach, resulting in a loss of approximately $223 million. The attacker exploited these vulnerabilities in Cetus smart contracts by introducing spoof tokens to manipulate the platform's price curves and liquidity calculations, effectively draining substantial assets from various liquidity pools. In response, Cetus promptly paused its smart contracts to help prevent further losses and collaborated with the Sui Foundation and network validators to mitigate any impact. These coordinated efforts successfully froze around $162 million of the stolen funds. However, the attacker managed to bridge approximately $63 million to the Ethereum network, converting the assets into Ether, trying to throw everyone off their trail. The exploit had a cascading effect on the Sui ecosystem. Several tokens had experienced significant devaluations, with some even losing over 75% of their total value. The total value locked on the Sui network plummeted by more than $330 million, reflecting a substantial loss of investor confidence. In an effort to recover the remaining funds and identify the perpetrator, Cetus has offered a $5 million bounty on information leading to the hacker's apprehension. The incident continues to underscore the critical importance of robust security measures in decentralized finance platforms and has continued to prompt discussions about the need for enhanced safeguards within the DeFi space. Charles Hoskinson immediately denies the $600 million data theft allegations and then orders a full audit. This week, Cardano's founder, Charles Hoskinson, he came under fire after allegations had surfaced claiming that he misappropriated over $600 million in ADA during the 2021 Allegra hard fork. Critics, they claimed that Hoskinson utilized a Genesis key to help move 318 million unclaimed tokens from the original token sale into Cardano's treasury, effectively taking control of the funds. The claims, they sparked a wave of backlash online, reigniting long-standing concerns about transparency and decentralization in major blockchain projects. Hoskinson strongly denied the accusations, calling them a coordinated smear campaign. He then continued to explain that the unclaimed ADA made up less than 0.2% of the total token supply and had remained untouched for over 7 years. Instead of being pocketed, he said, the tokens were then sent to Intersect, a decentralized governance group that oversees community decisions for Cardano. To prove his claims and restore trust, Hoskinson then announced a full independent audit of Input Output Global, IOG, with leading legal and financial firms firms reviewing every single transaction. In an emotional post, Hoskinson continued to say that the accusations, they were deeply personal and damaging, noting how quickly some community members turned against him immediately without seeing any evidence at all. He also revealed plans to step away from social media and hand over his accounts to a media team once the audit is released. For now though, all eyes are on those audit results because the outcome could either clear his name or it could cause serious confusion and long-term damage to Cardano's reputation. Texas advances strategic Bitcoin reserve bill. Texas is on the verge of becoming the second U.S. state to establish a strategic Bitcoin reserve, following New Hampshire. On May 21st, the Texas House of Representatives passed Senate Bill 21, known as SB 21, with a 101 to 42 vote. This bill, which had previously cleared the Senate, now awaits a concurrence vote due to House amendments before it can be signed into law by Greg Abbott. SB 21 proposes the creation of the Texas Strategic Bitcoin Reserve, a fund managed by the state. The reserve would allow Texas to invest in Bitcoin and other approved cryptocurrencies, aiming to diversify the state's investment portfolio and hedge against inflation. The bill stipulates that only cryptocurrencies with a 12-month average market capitalization of at least $500 billion are eligible for investment, effectively focusing on established assets like Bitcoin. Assets would be stored utilizing cold storage technology to help enhance security. Greg Abbott has signaled support for the initiative, aligning with his previous statements advocating for Texas to be a leader in cryptocurrency adoption. And if signed into law, Texas would join a growing list of states exploring the integration of digital assets into their financial strategies, reflecting a broader trend of institutional acceptance of cryptocurrencies. JP Morgan opens Bitcoin access to clients amid CEO Dimon's skepticism. In a significant shift, JP Morgan Chase announced that it will now allow its clients to purchase Bitcoin, making it quite a notable departure from CEO Jamie Dimon's long-standing criticism of cryptocurrencies. Despite his personal reservations, Dimon stated that we are going to allow you to buy it. We're not going to custody it. We're going to put it in statements for clients. This move aligns JP Morgan with other major financial institutions like Morgan Stanley and Goldman Sachs, just to name a few, which have already all begun offering Bitcoin-related services to all their clients. However, JP Morgan's approach is cautious. The bank will not provide custody services for Bitcoin, instead opting to reflect clients' Bitcoin holdings on their statements through third-party custodians. The decision comes amid a broader trend of increasing institutional adoption of cryptocurrencies, spurred by the approval of spot Bitcoin ETFs and a more favorable regulatory environment under the current U.S. administration. While Dimon remains skeptical, citing concerns over Bitcoin's use in illicit activities, the bank's move, it indicates a recognition of growing client demand for digital assets. SEC's Pierce clarifies NFT royalties are not securities. In a significant development for the NFT community, SEC Commissioner Hester Pierce clarified that NFTs incorporating creator royalties do not, in fact, inherently qualify as securities under U.S. law. Speaking at the SEC Speaks event on May 19th, Pierce continued to emphasize that such NFTs, which enable artists to earn royalties from secondary sales, are more akin to traditional royalty arrangements in the music and film industries rather than investment contracts. Pierce, who leads the SEC Crypto Task Force, noted that these royalty mechanisms, they do not grant NFT holders any ownership rights or claims to profits in a business entity, distinguishing them from securities. She likened the structure to streaming platforms compensating creators per play, underscoring that the economic realities of these NFTs do not align with traditional definitions of securities. Legal experts, including Oscar Franklin Tan of Atlas Development Services, supported Pierce's stance, highlighting that royalties paid to creators are considered business income rather than investment returns. However, they did caution that if NFTs are structured to distribute royalties among multiple holders beyond the original creator, they could potentially fall under securities regulations. Volatility, vision, and a glimpse of the future. This week showcased just how fast the crypto world can swing from euphoria to chaos and back again. Bitcoin hit a new all-time high, institutional players like JP Morgan finally opened the gates to Bitcoin exposure, and Texas pushed legislation to cement Bitcoin into state policy. These are the kind of moves that signal crypto is no longer on the fringe. It's moving straight into the mainstream. But it wasn't all green candles. Trump's aggressive tariff threats, they sent a shockwave through global markets, dragging crypto down with them. Meanwhile, Sui's ecosystem took a massive hit with the $200 million CETUS exploit, and Cardano was forced into damage control as Hoskinson responded to multi-million-dollar allegations. It's a reminder, the road to global adoption is anything but smooth. Still, developments like the SEC's clarifications on NFT royalties and broader institutional interest, it proves that this space is maturing fast. Foundations are being laid, not just for another bull run, but for long-term infrastructure that could reshape finance, art, and even politics. If this week is any indication, the next few months are going to be wild. If you found this roundup helpful, hit that like button, subscribe to JRNY TV, and let us know in the comments which headline shocked you the most this week. We'll be here next time to break down the madness, and until then, stay early, stay sharp, and we will catch you in the next one.